Hi, this is Kerry Artak with both Artak Advisory and Wicked Stocks. This is sort of a double whammy. I'm presenting the US dollar index analysis for both venues. It's long overdue. The last update was last September when we were testing this long-term channel top. I'll get to that in just a moment. But I do want to just present. This is a monthly bar chart of the US dollar index. And so we have a long-term rising one-third speed line. I'm going to break this down into kind of the big picture and then work my way and finesse these smaller numbers. But 101.11 to 102.12 is a trend-defining a long-term support level. It did contain the February lows, almost to the very tick. And from here, we can, as we move, I don't know, later year perhaps, over the next year, let's say, or sooner, we can rally back up to this long-term channel top that we tested in February. We tested in September and October. It contained the market pretty good. You can see that we pushed through it, but we never settled above it. It's at 114.20 for the month of March, and it rises to 115.05 by the month of September, or during the month of September. And also this rising one-third speed line will remain in effect so long as this high that we put out in September remains uncontested. So these levels we can now watch through the rest of the year. 101.11 is rising to 102.12 in September. I don't have the rate at which these are rising, but the math is pretty simple. Just subtract 101.11 from 102.12, divide by 6, and you have the rate at which this prominent, meaningful support level is rising on a monthly basis, somewhere between 12 and 15 ticks a month. The channel top is not rising so steeply. It's at 114.12, rises to 115.05. Once again, you can subtract them out, divide by 6, and you know exactly where that channel top is as we move through time. And this channel top is going nowhere as well, so long as the trend line upon which it's based is uncontested. So both of these line studies are likely to remain in effect through the rest of the year. So that is sort of the big picture. The 101, 102, 103 handle support as we move into later year is our base of long-term support, able to contain selling into next year, and above which we can, over the next full year or sooner, retest the 114.20 to 115.05 region, where we can top out on an annual basis. Remember, this is a 15-year channel structure, from the 2008 lows to the more recent 2022 highs. So I'm going to zoom in here a little bit and show you that right now, this monthly bar chart for the month of March is pushing through the February high. And that in itself is a sign of strength. Any weekly settlement above 105.35 should be construed as a sign of strength, as a buy signal up to 107.68. Certainly if we close the month of March above 105.35, that pretty much confirms it. This could be a matter of a month or two, I'd say at the most. 107.68 is our next meaningful resistance. Not only the low of the high, which is resistance in its own right, but also if you were to cast a 50% upside retracement, you would see that they are right on top of each other. So it is essentially a 50% upside retracement from the September high against the more recent February low. This is an area, 107.68, where we just might top out into later year, possibly through the year, and from there fall back to the 101.11 or 102.12 speed line over the following months, 3 to 5 months perhaps. We could fill the wedge between presently 101.11 and 107.68, narrowing monthly through the rest of the year. But if we do close above 107.68, that would be a sign of secondary strength. Follow through buying then expected into the 110s, the 114.20 to 115.05 formation, then sort of drawing the market, calling the market within possibly 2 to 3 months, could be 3 to 5 months, something like that. And while we're talking about this upper area, I need to mention that long term, well, this is already long term, but this is a monthly chart. The same monthly chart, by the way, goes back and shows you the 1985 significant high against the 2008 pullback low. This is a descending two-thirds speed line that is constructed using those two extremes. And it also can be given credit for having contained those buying pressures last autumn, September, October, November. It is presently at 112.91 for the month of March. I don't show the rate at which it's descending. It's in the 112 handle pretty much through the rest of the year or into later year. I will apprise you of the location of this if we close anytime soon, above, and I'll go back to this chart, above 107.68. So I'll start showing you not only the channel top, I'll shoot another video in the coming months if we close above 107.68. That will include this long-term speed line. This is a big area. We may have seen a good generational high like we've seen before. Now, generational may be a bit of a stretch, but a decade-long high perhaps. And in fact, there is a case, if you're looking at this channel top at 114.20 that we tested, there is a case to be made that the channel base, presently in the lower 90s, is in reach in the months ahead. There's just no clear indication of that. And the clear indication of 92.92 as a target would come if we settle below that 101.11 rising 1/3 speed line. So if we close the month of March, for instance, or any week, but the month of March back below 105.35, we can certainly ease back within several months to 101.11 to 102.12, depending on where this is at the time. Able to contain selling once again through the rest of the year, and above which, once again, we can rally over the next year or so back into the 110s. But if we do close any month or week below 101.11, wherever the speed line is at the time, then we enter another sell phase. It could be as little as 3 to 5 months. It could take the better part of a year before reaching and continuing south into the lower 90s. 92.92 rises to 93.85 over the following 6 months. Once again, you can subtract that out, divide by 6, and you know exactly where this is at that time. So I think this is certainly valuable analysis on the commodity side, RTAC advisory for the producers, the grain farmers, livestock producers, your export product. Knowing where the dollar may be in the future is a significant piece of information for you as you calculate your hedging and so forth and so on. As for the stock side, wicked stocks, it's also important because it does impact, stock prices. At least the extreme moves can. And knowing where these are, that this is in relation to all that, I'll let you be the judge of that. You may be more savvy than I am with respect to the stock market relationship, but there is a relationship between the two. A rough relationship, I should say. In the stock side, it's very rough because, the U.S. dollar index obviously is a relationship between the U.S. economy and its largest trading partners. Canada and Mexico figure prominently in that, as obviously does the European Union. But it is the relationship between those economies and obviously the interest rate markets between the two. So it is multivariable. And I don't want to get too deep in the weeds in that because it's just not my forte. So whatever this information means to you on the stock side, I'll just leave it at that. For the commodity side, it's pretty poignant. I'm going to leave it at that. I think there's not much left to say for this particular U.S. dollar index analysis for both RTAC Advisory and Wicked Stocks subscribers.